Hello, my name is Scott Hamilton. Today's micro lesson is going to be on diversification. Diversification is a simple topic, however it can be as deep as we want it to be. It can be complex and simple. It's don't put all your eggs in one basket. On a more complex level, there's two types of risk. You have total risk. It's broken into systemic, non-systemic risk. You can diversify away non-systemic risk. If the financial system is going to collapse, that's systemic risk. If an individual company is going to have financial problems, that's non-systemic risk. So therefore, you can diversify that away by having a portfolio of many holdings. So if you have one company that fails, all your eggs are in one basket. If you have 500 companies in a mutual fund and one of those companies fails, that's non-systemic risk, and it's diversifiable away. So that's one of the key components of investing. We want to be diversified amongst our holdings. But then again, we also want to be diversified across asset categories and classes. Cash, stocks, bonds, real estate, collectibles. So we can have various different holdings. So we can diversify amongst our holdings, amongst asset classes. There's another concept, though, and this is important because we don't know what the tax code is going to be in 20 years from now, much less 1 year from now, nor in a couple of months. It's subject to the whims of Congress, which can change on a political nature rapidly. So therefore, it's interesting and probably not a bad practice to say, let's take your wealth and diversify it amongst tax categories. So there's three major categories: tax deferred, tax after tax, and taxable. Three categories. So taxable is like your individual checking account or a brokerage account. You earn a dividend. That dividend goes onto your 1040 tax return. It's taxable. The qualified is your 401ks and IRAs. Those are before tax. So you put money in, you get a tax deduction, which is great, but you have to pay tax on the way out as required minimum distributions once you hit the required age. And if tax rates go up, it's so it can be a problem. A lot of retirees face escalating tax rates in their retiring years because RMDs are going up and tax rates are going up. However, the third category is after tax, and that's like Roth IRAs. And if you can balance and have a portion of your assets in taxable, a portion in qualified, 401ks, IRAs, and a portion in after tax and Roth IRAs, maybe balanced, but that's a personal preference depending upon where you're at in your life and what the financial plan looks like for you. But I have a lot of clients that tend to be overloaded in qualified, very little assets in taxable, and sometimes zero in Roth. So what a good strategy is in your younger years is to balance out your allocation, of your individual holdings amongst your asset classes and also across tax categories. And by the way, we should throw in diversifying internationally versus domestically. So that's just another way to further to the diversification. Half the world's outside of the U.S., so it's reasonable to have a part of your assets, even though they have underperformed recently, to have part of your assets invested overseas, or at least in companies that work in overseas, maybe overseas funds. So from a diversifying perspective, this has just been a quick overview of systemic risk, non-systemic risk, and how to diversify to reduce. What we're doing is reducing the volatility of your portfolio, so it'll allow you to stay in the market longer and not exit. Thank you for taking the time to watch. I appreciate your time. Thanks.